Plenty of people shy away from investing because of fear. In fact, a survey from Ali Invest found that 65% of adults say they find investing in the stock market to be scary and intimidating. Whether it's the concern you'll make a bad investment and lose money, or a lack of access to quality investing advice, at the end of the day, that fear is holding you back from really growing your net worth. The good news is there are many easy ways to invest. You don't have to worry about picking individual stocks and hiring an expensive advisor. It isn't always necessary. One of the easiest ways to get started investing is through index funds. What are index funds? Index funds are investment funds that follow a benchmark index, such as the S&P 500 or the Nasdaq 100. When you put money in an index fund, that cash is then used to invest in all the companies that make up a particular index, which gives you a more diverse portfolio than if you were buying individual stocks. Let's use the S&P 500 as an example. The S&P 500 is one of the major indexes that tracks the performance of the 500 largest companies in the US. Investing in an S&P 500 fund means your investments are tied to the performance of a wide range of companies. Why should you invest in index funds? Firstly, broad diversification. The most obvious benefit of investing in index funds is that your portfolio becomes instantly diversified, minimizing the likelihood of losing some or all of your money. Consider an index fund that tracks the S&P 500. This index fund would hold about 500 different stocks, while the performance of each of these 500 stocks fluctuates over time. Investing in a fund that holds all of them matches your portfolio's performance to that of the index itself. Diversifying your portfolio among so many companies by investing money into just one index fund ensures that your value of your portfolio is not overly correlated with the fortunes of any one company listed in the index. Number 2, low costs. Another major benefit of investing in index funds is that the costs, including taxes and management fees, can be lower than those associated with other types of investment funds. The first cost to consider is the management fee each fund manager annually collects. The amount of the fee, which varies based on the value of your holdings, is determined by the fund's expense ratio. If you hold $1,000 in a mutual fund with a 1% expense ratio, for example, you would pay $10 as a management fee. Actively managed mutual funds have expense ratios that often range between 1% and 2%. Most of that fee pays for portfolio managers to make buy and sell decisions in an attempt to outperform the overall market. Index funds, by contrast, are passively managed, since they simply track an index by buying and holding all of the stocks in that index. The holdings of the index fund rarely change. The expense ratio is comparatively low because there's little work required of the index fund's manager. Lower turnover ratio. The turnover ratio measures the percentage of a fund's holdings replaced in a single year. For example, if a fund invests in 100 stocks and 10 are swapped out this year, then the turnover ratio is 10%. Naturally, index funds have a lower turnover ratio than actively managed funds. Index fund turnover ratios are usually about 1% to 2% per year, compared to 20% or higher for some actively managed mutual funds. Lower taxes on capital gains. If a fund sells a stock for profit, then the difference between the initial purchase price and the final sales price is considered a capital gain. Funds with higher turnover ratios accrue capital gains more frequently, which results in more taxes owed by the fund's investors. This isn't as much of a concern with index funds, though, thanks to their low turnover ratios. Since fund managers aren't selling stocks all the time, they aren't often capital gains to pass through to shareholders. Number 3. Attractive returns. As Warren Buffett knew when he made his $1 million bet, even the smartest and most diligent portfolio managers can rarely steer actively managed funds to beat index funds. Only about 23% of actively managed mutual funds outperform the S&P 500 over 5 years, according to research by Standard & Poor's. Other studies support this number as well. Individual companies both outperform and underperform the market, but in